Good afternoon or good morning, everyone. Good day. I trust that everyone is well. You're all very welcome to join us in this very, very important conversation. And mine is first and foremostly to greet you very much and warmly on behalf of CABRI. I think most of you that are in the meeting are very well aware of our work, more specifically in terms of this debt management network, but also more broadly. So with our warmest intentions of having a great meeting where we unpack some critical issues for this continent, we then can proceed with our agenda. What we are going to do today is to pause a little bit at the point of the COVID-19 disaster, which seems a little bit far in the distance relative to some of the other things that have happened since. But at the point of COVID-19 and comparing that to where we are today, there are two countries that have had consistent, strong credit country profiles. They are Botswana and Mauritius. So we're going to kick off today by looking at, in some detail, what has been the secret to their success. How have they implemented strategies to ensure their country resilience, ranging from discussions on good governance, strong institutions, and also fiscal management, debt management practices in some more detail perhaps, and even legislation and other tools and techniques that they have used successfully. We do know that post the COVID-19 event, there have been many global impacts on our countries in the continent, including some of the political and geopolitical shifts, both on our continent and also on other continents that have influenced us. More recently, many countries in terms of their country debt status have had the impact of the sudden withdrawal of development assistance. All of these factors play into the investment that is desperately needed within the continent. I think it's common cause and everyone knows that the fastest growing continent in the next century is going to be our own. And essentially, there has to be investment in the future, and therefore there has to be investment in Africa. So I don't think anyone will disagree about that. But how do we get there? And more importantly, rating agencies play a critical role in positioning Africa as a good and competitive investment destination. So it's important for us to unpack what that means for countries and their ability to grow their economies and also our ability to grow within the region. So what are the next steps that we can take both as countries to act decisively in terms of the actions or recommendations of ratings agencies and the appetite for investment of investors, and also how can we collaborate to ensure that we do have this long-term investment, which is essential to help us to grow as a continent. How would we then move forward into a future of strong investment grading? I think that is the overarching question, and then we need to spend some time unpacking that. I'm going to then hand over to Ali Lali, that leads this work internally within CABRI, and ask her then to take us through the upcoming agenda, which I think you have, but she'll just give us some insights and some welcomes.
Yeah,
Thank
you so much. Thank you so much, Dr. K. And good afternoon, everyone. Firstly, I would also want to thank you for taking time to be part of this event. We are very grateful that you will be part of this event and you will be participating and interacting with us. without wasting time, we're gonna move to the next agenda item, where the title for this session is Achieving Macroeconomic and Fiscal Resilience. This will be handled by Anthony Julius. Anthony did some research on Botswana and Mauritius, and he's gonna take us through his findings and what can be learned from those two countries. Anthony, over to you. Thank you.
Thank you very much, Ali Lali, and thank you also for the introductions, and Dr. K, good to see you too, and all the other familiar people I would mention, because it may suggest that I'm not quite independent. I am an independent consultant. And as you see, my backdrop there, the National School of Government, I am also a facilitator. So I am independent, although it reflects my work in government and with the National School of Government as a facilitator, contributing or participating in the education, training, and development programs. So yes, this is a very important discussion. Thanks, Ali Lali, around sovereign ratings and processes. And we do have the benefit of being able to discuss these two countries, who are the only two African countries having this investment grade rating. And they're very different countries. And so the reasons for these two countries having an investment grade are not similar. What is similar, if I may just mention this, between Botswana and Mauritius, is that two factors that contribute to their strength, their rating strength, that are similar, are the institutional strength and these countries' susceptibility to event risk. These are two factors that, for both Botswana and Mauritius, are positive factors in terms of their rating, and these countries being sovereign investment grade rating. If I may just say, for Botswana, if I may just focus on Botswana, if you were to take all these categories, and I'll use Moody's as an example because Ravi is here, so I don't want to make reference to Standard & Poor's. Ravi, Standard Moody's, just taking economic strength, and for both these countries, I will look at the components of their current rating status, right, for both Mauritius and Botswana, looking at economic strength, institutional strength, fiscal strength, and susceptibility to event risk. For Botswana, one significant strength, which is not as significant in Mauritius, is the fiscal strength. Botswana's fiscal strength as an institution, the fiscal institution within the country. And what also is significant in Botswana is the institutional strength, as I mentioned before. These factors are significant. And so when you look at Mauritius, there are different factors, and we will get to the discussion on Mauritius. But let's focus on Botswana now. For the case studies that we did on these two countries, we looked at the location, how the two countries strategically have located the function for sovereign ratings management, or looking at their financial management framework to address the risks and to address a sovereign risk. We looked at internal processes within the two countries. We looked at the procurement and compliance processes as it relates to sovereign ratings, the strategies and measures that were implemented, particularly during the COVID period, how these countries were able to implement and develop strategies to mitigate the risks of COVID. And we also looked at the communication, an important component of sovereign ratings between to deal with the ratings outcomes, and then the lessons that these countries have learned from their engagements with credit rating agencies. So on the location and how the countries, Botswana in particular, located the function. Now, I'm going to just mention why it's important to appropriately locate the function to manage sovereign risk, because it is about managing sovereign risk. Ratings is about sovereign risk management or country risk management. Now, I will just mention that one could imagine a balance sheet, right? And managing a balance sheet of a sovereign. And so there's a lot of literature on that. And for a sovereign balance sheet, you have your assets and you have your liabilities, and we can look at the components, but the net of your assets and liabilities on a sovereign balance sheet is the net wealth position. The net of assets and liabilities on a sovereign balance sheet is the country's credit worthiness. Now, the credit worthiness is effectively an illustration or represents the sovereign rating status, the sovereign ratings ability and willingness of countries really to service their debt obligations. So we're taking a sovereign balance sheet approach. And I'm saying you've got to look at the performance of assets, the performance of liabilities, and how the two components of a sovereign balance sheet interact to deliver a particular net wealth or credit worthiness outcome. That is the overall. And so when you're locating the function, you got to locate it within the context where you are able to view the balance sheet of the country, where you are able to view, you are locating where you have access to assets and the liabilities, and so of the country. And so for Botswana, an important element of this asset is the reserves management, because there's a huge reserve. So reserves management is an important component of asset and liability management in Botswana. It has a very sophisticated framework. The Bank of Botswana plays a particular role, and there is important collaboration between the Ministry of Finance and Botswana. What Botswana also does in relation to reserve management is managing an enterprise-wide or government-wide risk management framework, right? It has a management framework that basically covers both assets and liabilities. And so, as an example, when Botswana government presents a budget, it includes in budget documentation the financial statements of the country, which covers the whole balance sheet. That to me is significant. It has and so we have the country risk management approach that includes the financial statements. Now, in order to deliver what it has delivered now, in order to arrive at this level of ratings, of investment grade rating, because these are just the outcomes. It needed to implement reforms prior to this delivery of these outcomes. And so early on, already in 2010, the government of Botswana adopted a very comprehensive and integrated public finance management reform program. That was done in 2010. And so what we are seeing now in terms of its rating outcomes is really the fruits of that reform program already implemented in 2010. Again, I would just remind your participants that we are looking at implementing, undertaking reforms either on the asset side or the liability side of a balance sheet to deliver the type of net wealth or credit worthiness outcome, which is what we are experiencing, what that is reflected in the sovereign rating. So if you go on to the internal processes, sovereign credit rating processes, one thing that I would mention is that what is very clear, again, it is the outcome of an institutional arrangement that allows the government of Botswana to implement policies in a particular way. In relation to sovereign ratings, it is very clear on its primary and on its secondary debt management objectives. The primary objective around debt management, it's about financing the needs of government, needs and the payment obligations of government. The secondary objective is very clear, communicated to everyone to support the domestic capital markets. Internally, besides just having very clear objectives on debt management, when you look at the budget strategy papers that is prepared, the 2023-24 budget strategy paper for Botswana mentions very clearly it includes vulnerabilities that exist, it identifies those vulnerabilities, and it identifies areas to monitor. So it says, what are the areas that are that may be vulnerable areas around fiscal strategy? These are very clearly articulated in their budget strategy papers. To spend less, and to save part of the resources when there are windfalls. You need to understand the Botswana economy, obviously being very the economy dominated by the mining sector and diamond mining in particular. And so there's a particular direct link between reserves and diamond exports. And so how any windfall is managed, that also talks to institutional strength. Internal communication is important also when it comes to, right? When it comes to processes to manage sovereign ratings. And so, and we can go into the detail how Botswana uses the broadcasting we referenced earlier was made to broadcasting tools, how the newspapers, etc. are used. Let's go to the procurement area for sovereign rating processes in Botswana. What the Botswana government does, and institutionally it is able to do so, is to ensure adherence, right, to the International Organization of Securities Commission, the IOSCO principles. There are 4 important principles that are important when it comes to supporting the development, right, of the credit ratings process. So very briefly, it is about the quality and integrity of the ratings process. It is about the independence and managing conflicts, etc. I mean, these things, these one could just, you know, make note of, because these are important principles. The timeliness and the ratings disclosure, the confidential nature of information that are shared with rating agencies, these are important. So in terms of procurement, generally it talks to transparency. It talks to being very transparent and having open, trustworthy engagements. And noting too in Botswana that you have the procurement unit in Botswana actually located within the office of the accountant general. So that talks to procurement. On the objectivity of ratings outcomes, it is important to note that the internal audit process, internally, the government of Botswana internal audit also reports on the budget execution and on related plans of government. Those are reports that are also prepared by internal audit within the government of Botswana. On strategies that the Botswana government were able to implement during COVID, an important, won't mention all, but an important development that occurred following the COVID pandemic 2020 was the rationalization of state-owned enterprises. There was significant rationalization of state-owned enterprises, parastatals, and there was an establishment also of a new ministry, right? Let me just go to the next, if you could go to the next, and then I can just wrap up on Botswana and just mention that being able to look at the trend, being able to look at where the strengths are, identifying the strengths, identifying what the weaknesses are, and being able to communicate those messages on a very consistent and coherent basis. That also talks to the institutional strength and the economy being able, well, having delivered a very strong economy that allows the government to communicate consistent messages and articulate these messages across the public sector. I'm gonna leave it at that for Botswana. There is the one risk that, yes, it does have a very narrow economic base, and so it is always attempting, finding, undertaking efforts to mitigate this heavy reliance on the diamond industry. And so those are ongoing reforms, but it does benefit from a significant wealth fund, and noting also that the government pension fund is fully financed and fully funded as well in Botswana. I think I will leave it at that for Botswana. Taking all of that together delivers a particular investment grade rating, where most of the sovereign rating categories, if you were to take them individually, are in fact rated above in the investment grade rating, right? Because one could do that if you and these reports are available if you were to take just the Moody's reports and you were to take and rate each of the categories of sovereign rating. For each of the categories in Botswana, all except one of those categories are rated investment and above. The only one that is rated below in Botswana is in fact this reliance on the diamond and the diamond industry, and therefore economic strength. Economic strength is one of the weak areas in Botswana. All other areas, institutional strength, fiscal, economic resilience, financial strength, all of those are rated in the investment grade rating.
Okay.
So I'll conclude with that.
All right, thank you. So with Mauritius, you're gonna have to cover Mauritius with only 3 minutes, unfortunately, if that is possible. Thanks. Can we
I covered Mauritius
have
in 2 minutes.
Mauritius? Yeah, yes.
I'm going to do it just by giving a very succinct overview of the situation in Mauritius. If you were to take Mauritius, and we could go to the next slide, if you go to Mauritius has the one strength, and it is its institutional strength. And this is, I'm sure, by design. And it is the country that has, I think, well, there's an enterprise-wide risk management process. It looks at it. The risk management and sovereign risk is effectively run by the Office of the Prime Minister, and its institutional strength has always been rated over the period 2017 to 2013 above that of the ratings of the country. So it has always been ratings positive. The other factor that has also been strong, unlike the situation in Botswana, as a rating strength, has been its economic strength. So economic strength in Botswana over the period right up to COVID and into 2020 has been rated equivalent to the sovereign rating, just that as a category. What then happened after COVID is that economic strength has gradually declined. It was a factor that also contributed to the ratings of the country falling, whilst obviously remaining above sovereign rating, but economic strength declined. The weak category, one of the weak categories within sovereign ratings for Botswana is its fiscal strength. And so fiscal strength is an area that was rated above investment grade prior to 2020, but due to the COVID situation in 2020, fiscal strength decline relative to the overall ratings. And so it is a factor that has been pulling down the sovereign rating. Another area that is equivalent is just event risk management. And so it is able to, I think, also given its relationship with the broader, bigger partners, India, with the countries, relationships with countries on the continent, it is able to mitigate a lot of, it's being a small country and therefore susceptible to event risk, being able to mitigate event risk as an important component of sovereign risk rating and therefore sovereign ratings. So that would be in brief on Mauritius. Thanks, Ali Lali. I'm not hearing you, Ali Lali.
Can you hear me now? Oh, thank you.
I can hear you.
Thank you. Thank you so much, Anthony, for the two presentations. Very insightful. The presentations will be on our website. Should participants want to view more and analyze the presentation more, they are welcome to do that. They are available on our website. And now, what I forgot to mention is with the agenda we have changed that we will have a Q&A after each session so that you don't get bored and just listening throughout, people talking. So it's much better for it to be more interactive. So we're going to have a Q&A after each session. So I will open up to the Q&A. Maybe while I still do that, a question maybe that may be posed on Mauritius and Botswana is, are we comparing apples with apples? And again, apart from Botswana and Mauritius, what fiscal anchors have been proved to be more effective in helping countries preserve their sovereign credit ratings? This is apart from Botswana and Mauritius during period of economic stress like we saw with COVID-19.
Should I respond, Lilali?
It's open to every speaker
For
if
anybody,
they have.
I see.
Yeah.
Okay.
Oh, Jasper has his hand up.
I'm
Please.
happy to kick it off.
All right, thank
because
you.
I think that it's a very, before I answer the question, actually, one more comment on the point you just made. Are we comparing apples and apples or apples and pears? And the discussion around credit ratings in particular that has now, intensified, as we said at the start of the sessions over the past year or so, is always circling around who is it actually interesting for, at least for me to a large extent. So for an investor that looks at these ratings, if it's in the same rating categories, it's apples and apples. So, and I think that's important. So whatever sits underneath that is, of course, has relevance to an extent, but why do these ratings exist? And I think in the start of the session, it was mentioned that credit rating agencies play a critical role in positioning the countries.
Yeah.
They do and they don't. The role that they have is to evaluate the likelihood of default on external debt. That's the role. Obviously, that then leads the fact that it has is that it's portrayed to the public or to investors in a certain way. But the role is not really to position it's good or bad or wealthy or not wealthy, or the balance sheet looks great or it doesn't. It's really the likelihood of default. So I just want to, and I'm sure that the rating agencies who are on, Ravi and Paul, that's what might have been one of your points too. On Botswana, Mauritius, I think apart from the institutions which are strong, one key thing just to add to Anthony's presentation is they were able to finance their COVID response not through borrowing. Botswana did it through central bank and, Botswana did it through the Pula Fund, and in Mauritius, they do it through central bank reserves. So that's in contrast to, for instance, Ghana and other countries that didn't fare so well throughout the crisis. There is a question about diversification of the economy, which helped. Botswana's financial industry was fine, tourism wasn't anywhere really. But another key point is that debt to GDP already wasn't that high. For Botswana, I think it was around 20-25%. And Mauritius, it was slightly higher, but they didn't increase their borrowing significantly during COVID. Again, in contrast to others. Just to add to Anthony's point. On other kind of fiscal anchors, as we call it, there is kind of three that I can start to talk about, and then people, I don't want to monopolize the conversation too much.
Yes.
The one is expenditure and budget rules. One great example of a rule in this category is the structural balance rule in Chile. So Chile is copper rich, as is Zambia, as we all know. They have also strong institutions and so on, but they are able, or they have the rule that if there's a boom, you don't spend. If there's a bust, you spend. And that is one of that's a key area of their fiscal structure that helps them to be disciplined in the way that they spend, and they spend countercyclical. In Africa, we do have some of these rules in some countries across the continent. They are more or less adhered to. They are more or less implicit or explicit, and they are often suspended and breached. I don't need to mention countries necessarily, but there are some West African countries where this happened again and again. Again, one budget or expenditure rule that is applied in Botswana, for instance, sorry, we said beyond, but it works, is what Anthony referred to with transferring proceeds from the natural resources from the diamonds to the Pula Fund. So I'll be quicker. Debt ceilings is the next category. There's a range of different countries that have them. Kenya, Rwanda, Namibia. The WEMU region actually has a wider one for across the region. That again, adherence varies, but it helps. Nigeria has one, sticks to it, although getting close to the cap at 40%. But they were upgraded by Fitch and Moody's just recently. And one element of fiscal discipline was the debt ceiling. But Paul, I saw you nodding. You probably can comment better on the analysis than I can. And finally, financial buffers. We talked about it with sovereign wealth funds. The main benefit from financial buffers in these three categories for us is that you can really get an immediate upgrade if you have more financial buffers. If you say, I have a debt ceiling, you kind of have to prove that it works. Financial buffers through the sovereign wealth fund or foreign reserves, sometimes gold, although Moody's doesn't account for gold because they don't regard it as liquid enough, help. And what we see in recent years with the gold price, or especially in the recent year, half a year, with the gold price going up like crazy, that reserves of countries have increased. So focusing on building financial buffers is important. The last point I want to mention is most of this stuff doesn't actually or isn't as effective if you don't have the institutions to support them. So while it is different categories, there is obviously a link between them. So the Chilean example works because they stick to the rules. Same with Nigeria. If they now breach their cap, that's not good. Mauritius did basically suspend their cap of 60% GDP during COVID. That's not necessarily positive, but if communicated right, and we'll get to that too, rating agencies understand why you have to do it if you have a long-term plan to be able to again service your debt. So maybe pause there. Maybe I spoke for very long now and hand over. I mean, Ravi has his hand up, but back to the moderators.
Yeah, maybe if you like, I can comment. Yeah. I mean, just to say, indeed, on these two countries, we have them along with St. Helena Island in investment grade in Africa. So we have these three in investment grade. And I mean, they've actually done very well in terms of a track record over many years of using resources and opportunities to develop their economy. With Botswana, they've had diamonds, but they've used the resources from diamonds to build up the Pula Fund and sovereign wealth funds, and also to spend on social development and really enhance education and social development across the country, and then push to develop the country. And in Mauritius's case, I mean, similar, but they used also their concept of being an offshore financial haven to really develop. They pushed this financial sector, which actually worked very well. At one point, they were the largest foreign investor going into India because of benefits of a double taxation agreement and other aspects. So they both institutionally, they've had strength with good checks and balances, and then they've pushed a sort of mechanism to make them unique. I mean, and develop in a unique way. In Botswana's case, it was using the diamond proceeds and to a less extent tourism and beef cattle farming. And in Mauritius's case, it's tourism and also this offshore financial sector that they developed. But just to add that more recently, despite being investment grade, I mean, they've both hit some hurdles. In Botswana, for instance, there's a lot of pressure from lab-grown diamonds because Botswana has been, producing natural diamonds, but now we have this concept of the lab-grown diamond, and it's, the market for that is expanding, and it's competition for mined diamonds, and in the current environment, we're seeing a limited demand from the US and China for diamonds. So the diamond sector has actually been struggling somewhat. So they're again pushing for diversification into other minerals. But in the interim, they've been eroding their fiscal buffers, and they've drawn down on their fiscal buffers, and they ran a big fiscal deficit last year. They also had an election where for the first time the opposition won. So they're kind of under fiscal pressure at the moment. And it's actually quite similar in Mauritius, where they also had an election and then a transfer of government and a large fiscal deficit that they are now having to contend with, and also a reassessment of their debt stock to higher levels. So yes, they've had a long history of success, but at the moment, some issues with their model. But they're definitely poster cases for being an investment grade in Africa. I'll leave it there.
If I could also just say a couple of things. Firstly, on sort of Jasper's point and about fiscal anchors. Key thing for us, one is credibility, and two is adherence. So if you have fiscal anchors have to be credible. If a fiscal anchor is too tough, you're not going to adhere to that. If a fiscal anchor is too loose, it doesn't mean anything. It doesn't actually impose a constraint on the government. So the fiscal anchor has to be credible, and then it has to be adhered to. And we need to see a track record of adhering to a fiscal anchor. Now, I think all well-designed fiscal anchors do have escape clauses. And I think COVID is a time that you would activate an escape clause. But again, that escape clause would be documented or would be clear in the construct of the fiscal anchor. So I think that's important. And then in terms of Botswana and Mauritius, if you look at the way we do ratings at Fitch, we start with a sovereign rating model, we then make adjustments. Within the rating model, the largest pillar is structural. And within that, the two largest components are governance and GDP per capita. Governance, we use the World Bank governance indicators. And here, Botswana and Mauritius really stand out for sub-Saharan African sovereigns. Two highest rated sub-Saharan African sovereigns there. Their governance levels for us are consistent with a single A rating. There are other elements of the credit profile that drag them down. But they, we look at governance as consider a percentile ranking. Both of those are in the low 70s for us. The average, the median sub-Saharan African sovereign is 33. So really significant difference there. Other than GDP per capita for us is an indication of the economy's development, economy's resilience to shocks, and kind of the quality of the labor, the capital investment in the economy. Again, Botswana and Mauritius really stand out here. So Mauritius, about 12,000, Botswana coming up to $8,000 per capita. Sub-Saharan African median is 1,800 for Fitch rated sovereigns. So again, they are two things, these kind of structural things that are very important for us ratings agencies, where those two really stand out from regional peers.
Thank you very much. That was very, very insightful. I'm also learning new things today. So while we are still on the sessions, maybe we can open up to the participants and share maybe their views or perspective, and then we can move over to the next section. Let's just check if there are questions.
Alilali, I don't know, I have a comment and a question.
Please go ahead, Sam.
Yeah, it's quite impressive what the record for the ratings for Botswana and Mauritius have been. And looking at the key drivers of these ratings, which are basically institutional framework and discipline and the quality of those institutions. Of course, the level of debt and economic progress. What I just wanted to know, for example, do these countries have a specific ratings improvement programs in place where they're looking at previous ratings, factors that were identified as being strong and weak, and whether they have any deliberate activity to improve on those factors so that they can get a better rating or maintain the ratings that they have? What is the experience? Thank you.
I think Ravi and Paul, please, you can step in on.
Yeah, I mean, I can start. It is that, as we've been saying, they have very strong institutions, and then they've been working with, these are relatively small economies in the global scale. So they have to find a niche, and they have to sort of find an avenue that will help their development and help improve GDP growth levels. As Paul pointed out, they have much higher than the African peers on GDP per capita. So they've both carved out this niche. With on Botswana, it's diamonds and then and tourism, and on Mauritius it's been tourism and sort of offshore finance. So they've been building this, and they're trying to carry on with this model while at the same time diversifying and going for value add across their economies. And that actually, once you have good institutions, you raise your GDP per capita. You keep fiscally consolidating. Your debt stock is low, and your external imbalances are low. Then automatically, looking at those metrics, you get high ratings. So it's more a case of whereby I think they're focused on their core economic strengths and developing their economies, and then also they've tried to get higher ratings and interacted. But basically the core underlying, when they build their economy and raise GDP per capita and keep fiscal under control, that gets them the higher ratings. So it's if you do that, it delivers higher ratings, and that's what we've seen.
And I can just add that in all the press releases, so all the rating action commentaries that we put out, we explicitly have a section that could say what could be positive for the rating and what could be negative for the rating. So we're very transparent in that.
And I just mention, I think.
Go ahead, Anthony.
That Mauritius, I think, prioritizes it puts a lot of emphasis on its transparency. I mean, you also have Mauritius transparency, reporting a lot on the budget processes in Botswana, in Mauritius. And so it gives a lot of attention to the whole budget process. Our experiences that we've had in South Africa, for example, around submitting a budget, we've had 3 attempts in South Africa. In Mauritius, there's a process of engagement, very deliberate, transparent with civil society, and in particular incorporating the youth in the budget process and submitting budgets in Mauritius. And that's also reported on. And I think that is a particular strength, because youth unemployment in Africa and the informal sector in Africa should be one of Africa's strengths. And if designing a financial market in Mauritius for the continent, because this is the financial center. It is with an international rating for the continent. And it is recognized as the only international financial center in Africa with an international credit investment grade rating, which is in Mauritius. And it works a lot on it. In Botswana, the emphasis is having the bigger picture, understanding the financial statements of the sovereign. And that is managed within the Ministry of Finance, and being able to have a very detailed insights into assets and liabilities in various forms impacting the wealth of the country. And that is the overall, and that is the approach in Botswana, to target the country's wealth outcome, being so dependent on diamond exports, and therefore being able to manage, being disciplined around managing its diamond revenues and wealth. Okay.
Thank you so much, everyone. And I guess we understand moving forward that governance and transparency are also part of key in us enhancing towards sovereign credit rating. So we're gonna move to the next session, which is also very interesting. This is mainly, most of it is going to be directed to the rating agencies. So Ravi and Paul, this is to you. We all know that there are perceptions of rating gaps and biasness and misconceptions. particularly when we relate them to emerging market and African economies. What do you say to that?
I guess I can start. We talked a lot already about transparency. So transparency is super important for us. If there are perceptions of rating gaps, misconceptions, they are perceptions. That's not how we see it. When it comes to transparency, it's really important for us in a number of ways. So first is in terms of transparency for our methodology and transparency for our criteria. So all our criteria publicly available. I should highlight that at the moment we're looking to change our sovereign rating criteria. There's an exposure draft of that on our website. So anyone can see the proposed changes to our sovereign rating criteria. Anyone can comment on those changes to our sovereign rating criteria. And we do take note of these comments. So in terms of that, we are very transparent on our methodology. When you dig into the methodology, as I said, we have two core parts of that. One is a rating model, and two is then the adjustment framework. In terms of the rating model, so not only do we publish the outcome of our rating model on all our press releases, we actually have the rating model on our website. If you want to go in and plug in the numbers and see what rating it puts out for a specific sovereign, that's there. That's all in the public domain. And again, we have a downloadable model. You can play around with whatever you want to put in, and that tells you what the rating model is. Then we go beyond that for the overlays, and the overlay is how we adjust the output of the model, because I don't think anyone thinks that models can tell you everything. Then if you look in our criteria, it tells you the exact factors that we can adjust the rating model for. And it's, again, just to highlight, we use the same rating model for every sovereign, and we have the same adjustment factors for every sovereign. It's nothing, not regional rated at all. And maybe the final thing that we do as well is we do transparency presentations. For any government that we rate, if they want to understand their rating, obviously we have this ongoing dialogue with the governments, but we will sit there and we'll give each government a methodologies presentation, walk you through the model, walk you through how we get to our inputs in the model, walk you through how we adjust things, also look at how we adjust things for peers. I think that's kind of, again, an important point that sort of that Jasper made earlier. When we think of peers, if you're looking at South Africa, double B minus for us, that's Jamaica, that's Turkey, that's Uzbekistan. That's what we're doing. We're getting all those ratings consistent. That's transparency, is how come all those ratings are consistent. And so we do that with the governments as well. So we think transparency is kind of a two-way street. Obviously, we want transparency from the governments that we speak to, and we are going to be as transparent as possible. And maybe people don't know, maybe people should ask more, but we do these things for a lot of sovereigns already, and we're always happy to do that, because we should both understand each other as part of this process.
Okay, Ravi?
Again, we have a criteria for sovereign ratings, which is publicly published. And again, it's the same criteria and the same thresholds that are used all around the world. So the idea is that a single B-rated credit has the same risk, whether it's in Africa or in Latin America or in Asia. And typically what we find when we do our look-back studies is indeed that the assessment of risk for across, regardless of which region it is the same at that rating level. So that doesn't point to bias on Africa. And a lot of the analysts, we have a team which are very sort of, they have international exposure, but also a lot of African expertise. We have an office in Johannesburg with analysts, and we also have a lot of analysts who, while being international and looking at all ratings across the spectrum, have an Africa focus, which includes Julia and myself on the call today. And also, we're quite familiar with Africa. For example, I grew up in Kenya, so it's a long-standing association with the continent. But at the same time, also able to look at the comparabilities of ratings across the regions. And I think so. There's really we don't see a bias coming in, and I think if you look at the look back studies, there's no evidence of bias. And I think on a more positive note, I mean, there's a lot of appetite for countries to get sovereign ratings and to maintain the ratings that they have, and as you say, to rise up the rankings and get higher credit ratings. And the ratings have also helped facilitate a lot of finance to come to the continent. Because in the old days, financing avenues were multilaterals, and it was really, you're looking at the World Bank and IMF and multilaterals. And now what ratings have facilitated is really a move into commercial financing and the issuance of euro bonds, where a lot of countries have gone on to the bond market, which is linked, to the ratings and the rating level the markets look at, because we rate commercial debt obligations, and that has facilitated over $100 billion of money to come to the continent, which helps development across the continent. So it's part of the architecture that has permitted all this financing and open new avenues of financing for the countries. And it's also another sort of look at the macro story. The IMF and others produce reports on the countries, but so do we. So investors look very closely at that. And we've seen the establishment of really an African debt market where there's a lot of funding and the Eurobonds are issued and funds are investing across the board. And it's very dynamic now. And this has developed over the last 25 years. So it's really helped sort of investment and development across the continent. So what we're seeing is there's an increasing demand for sovereign ratings across the continent, and from corporates and banks as well. So there is an appetite, and also the appetite to issue. So I think it's part of the development equation that we're seeing, and especially with the development of commercial debt markets. Yeah.
Okay. Thank you so much. That was very insightful. I was not even aware myself that I can go to your website and plug in our debt numbers or whatever fiscal numbers, and then we are able to see where we are in terms of ratings. At least that's what we can take from this session. And I just have, because in the interest of time, I'm just gonna ask Sam to come in on we heard about the transparency and the governance. So the resilience building strategies that commodity dependent countries can maintain the credit rating agencies during the period of market volatility. We do know that countries like Ghana, they have defaulted. We do know that part of their cocoa, they regard cocoa as one of their commodities for revenue. So what do you say to that, Sam?
Sorry, Alilal. Timbi has a hand raised for quite some time.
Sorry, Timbi. Aski, sorry. Timbi?
Thank you, Alilali. So I just wanted to get a sense from the ratings teams. When a country has an extended period of low growth, basically since 2008, South Africa has been in a low growth environment. Is it just a race to the bottom, even with all the, the institutions that we have, the governance, transparency? Yes, we have had some challenges with corruption and state capture and the like, but I think predominantly low growth and persisting debt problem. Are we on a race to the bottom? Is at this point, is growth the only lever that can save us? How do you think about countries in this situation?
Yeah, I mean, I'm happy to start, and then Yeah, I mean, growth is a very important part of the equation. There's no two ways about it. Because economic growth then feeds into higher GDP per capita and higher wealth in the economy, and wealth provides the ability for the government can tax that wealth, and that supports fiscal revenues, and then that supports the ability to repay their debts. So there's really no going away from the fact that countries that have, or let's put it positively, countries that have grown fast and kept their fiscal under control, very quickly we see their metrics improve. Whereby, if they've grown rapidly and they haven't spent on the fiscal, then things can improve, and it really supports their rating trajectory. And we have examples, Benin comes to mind, and Cote d'Ivoire as well. So basically and indeed for South Africa, it's been a long-standing problem, as you mentioned, whereby they're trying to consolidate, but then every time they have to revise their growth numbers down, uh, and then that has an impact on their revenue estimates and the fiscal revenues. But the expenditure pressures actually increase when you have lower growth, because you need a bigger social security net. So then you get somewhat in a downward spiral. And so basically, this issue of getting growth via effective reforms is important. And of course it's very important for the country. And we've seen, of course, China grow to be the world's second, or if you look at it on PPP, I mean, the world's largest economy, based on rapid growth for several decades, on a consistent basis. And that has really delivered changes in the entire global economy. So to a less extent, the African countries, once we've seen strong growth, as we mentioned, the strong cases like Botswana and Mauritius as well, that has delivered a good story, and then eventually higher credit ratings. So yes, there's really no easy way of getting away from growth.
Yes, I mean, similar thing. Obviously, that growth is the best way to raise revenues, which is the best way to address some of the fiscal challenges. I wouldn't say it's a race to the bottom in terms of the rating. We, as I said, we have our sovereign rating model. We already make two negative adjustments for that. One is because of very weak trend growth. One is because of the structural factors that kind of hold back growth, but also hold back fiscal performance. So for us, you would need a pretty substantial increase in government debt, or you would need another shock to growth. So if growth carries on at its current trend rate, that's not really, that wouldn't put downward pressure in. We've got there's a lot of the downward impacts of the weak growth and its spillover to public finances are already in the ratings. And I think the other thing to say is, as you start to get into single B rating territory, here we're really thinking about default risk, and that's just something we don't see in South Africa. This is where the institutional things come through, the strength of debt management, but the broader policy credibility within the economy sort of underpins that. So it's certainly not a race to the bottom, because as you go further down the rating scale, we're thinking about slightly different things, particularly when you're coming towards default, and so getting towards the bottom end of the scale.
Okay. Thank you so much. I saw Anthony, you and Jasper, you had raised your hands, but I'm gonna allow Katleho to come in first because we haven't heard him, and then we can move to you, Anthony and Jasper. Katleho, go ahead.
I was hoping Jasper would go first, because I actually have a question for the rating panelists, but I might as well ask it now.
Yeah.
I think we're seeing a trend currently in the world where the universe of AAA rated economies, at least by two or more rating agencies, or the big three rating agencies, is becoming smaller and smaller. Now, in your views, is this a trend that's gonna carry on going forward, i.e., there will be less AAA rated economies? I mean, I think the US is also like AA plus across all three rating agencies. So is it a trend? Is it a concerning trend for you guys? Or do you think, and especially given the current geopolitical context, which I think we're going to live with these geopolitical risks going forward for quite some time now. So is it something that you guys are worried about, or do you think at some point the tide will turn and a lot of the former big economies will go back to being rated AAA across at least two of the major rating agencies?
Yeah. Okay. I think before they come in with the answers, we had indicated that we would encourage the African participants countries to also participate in these Q&As. Please do come in with your questions. You have the rating agencies here as part of the speakers. They are here to answer any of the questions that you may have. Please feel free to raise your hand and ask the question. And if I do miss it, we do have our media team who will pick it up and let us know. Please feel free to ask questions because this session is mainly for you. Thanks. I think maybe we can have Jasper and Anthony and then we take the response at once. Thanks.
Thank you. Thank you, Ali. Let me just be brief, just in responding to Tembi, from the perspective of an issuer and being able to defend our ratings, engaging with rating agencies. What has been challenging is that we've always had, I would say, an element of optimism bias in presenting a budget and then having to present again post the medium-term budget worse outcomes than what was initially projected. And that over time has led to a lack of less credibility in what was presented. And I wouldn't say it would be a race to the bottom, but it is an appreciation that implementation is not the domain of the Treasury. Implementation is government as a whole. And so you can present a budget, if you don't deliver the outcomes, that is really a function not of the budget itself, but a function of various elements within government being able to perform and deliver. And so that credibility is what has led to the downgrades that we've seen in South Africa over a period since 2009. And so that would be just on should we be worried about the AAA rating? I think a lot of what we are discussing should also, I think, relate to better context around ratings. And so to understand Africa as a different continent from any other continent when we look at AAA ratings, the question being asked. And so being able to understand regional, continental dynamic is, I think, the direction that we would be going in terms of ratings of sovereigns. Thank you.
I'm fine, actually. Let's move on. I think we're behind time. Thank you.
Adilali.
Yes, Sam. Go ahead.
I think you had asked me to make some comments on the trends that we see on the African continent, particularly in economies that are dependent on commodities like Ghana, on cocoa.
Yeah.
If you come to countries like Kenya, you got coffee and tea.
Yes.
Outside of what you call mineral mining. And what I notice is that...
But Sam, before you proceed, are you aware that your your camera is off, or is that deliberate? I think...
I have put it on. Is it on?
No, it's not.
So
it's
Sam,
not. No, but you can...
If you want, if you hover at the bottom left by where it says video, and if you click on the up arrow, select your camera, but it looks like you either have the switch on the camera off or the flap is closed.
Okay, Sam, while you are fiddling with your computer, I think maybe you can go ahead and try to respond to the question while you're busy doing the IT stuff there.
Okay, so I was going to say that these factors, because they are critical to the inputs that go into the metrics for ratings in terms of the incomes that they generate, and in terms of the volatility that is associated with these specific commodity items, it then becomes a challenge for most African countries because governments need to raise money to support socioeconomic program, healthcare, education, and if there's not sufficient growth coming from these particular items, then the growth rates become affected, sometimes become negative. And if you have to continue supporting these programs, then you have to expose yourself to external borrowings, which, because of other factors that have been mentioned, tend to have low ratings. And what we've seen, for example, in Kenya, is that every government that has come into office has tended to borrow heavily in external markets to support infrastructure programs. And that has basically taken the debt to GDP ratio to what you would call above what would be the threshold value. So I think what I would probably want to know from the rating agencies that are in the House is that in terms of when you're looking at economies that have this kind of vulnerabilities, how much can you be able to accommodate them in terms of, one, enabling them to access external borrowings at rates that they can be able to afford so that they can support their domestic programs? Because without access to this financing, again, you basically fueling the problem at a domestic level, and that's, we have seen, brings out a lot of uprising within the community. So how much of these factors can you be able to rationalize in order to sort of like put these countries on a ratings improvement program so they get better and they can access more capital at an affordable price? Thank you.
Yeah, maybe I can start if you like. I mean, it's definitely a factor that some economies are reliant on one or two key commodities. And then when there's a shock to the commodity price or a shock to volumes, that has a big macroeconomic impact. I mean, we've just discussed, but at the same time, it's also a boon because it provides them, when the commodity prices are high, it provides them with windfall revenue, and volumes are big, then it provides them with windfall revenues. So it's really a case of management. Uh, and exactly like we discussed with Botswana, I mean, it's largely they have, their biggest sector is diamonds. And diamonds are also highly cyclical in terms of prices and volume demand. So in fact, they have consistently in the good years, they have sold in excess, and then they have used those funds to beef up their Pula and sovereign wealth funds, which has built up this net external and net fiscal asset position. And that has helped them on the rating side because on a net basis, they until recently were really very strong. So it is a case of being aware that your commodity could be, you're going to get cycles of boom and low prices. And when the prices are high, it's similar thing that the oil exporting economies have to deal with. So, in that sense, it's typically good policy to decouple your expenditure away from when you have a boom period and you have high commodity volumes and exports, then it's a good policy to save and keep your expenditures under so you can store up this money for a rainy day when the commodity price falls, and then you may have to draw into your reserves. And that's where the fiscal rules also come in. The fiscal rules that cap spending and decouple it from the circularity of revenues coming in. That's typically good policy. So yeah, that's how countries can handle sort of a single or two commodity economy that helps them through the cycles. I'll hand over to others. Thanks.
Jasper, you can come in.
So this is a point I wanted to make earlier, but I think it's important just because Sam spoke about this as well, and Ravi talked about it. I think it's questionable whether it's a great move for African market countries to go to the Eurobond market. I mean, I think the jury is still out whether that's actually benefited them overall or not. There are cases where it makes sense, and where it worked very well, but issuing bonds at around 10%, struggling to refinance those, I think I couldn't definitely say that that's a good thing for those countries. So, and that comes back to Sam's point around if you're financing social spending with external borrowing, that can't be sustainable. It doesn't work.
Yeah. Yeah, correct. So I guess I also
maybe just to add, that's not the rating agency's fault, right? I
Yes.
mean,
Yes.
the agencies don't have they just evaluate risk here. So it's
Yeah.
not up to them to say countries need to go to the market or not, or how much they need to borrow. They just say, if you borrow, that's your likelihood of not paying it back. Sorry, just to say that's not I think these are two separate topics.
Yeah. So I guess maybe I also agree with you, Jasper, but I think for me, the challenge would be if you want to raise substantial money, for instance, in hard currency, and you are not able to achieve that in a local currency. And I guess the other problem with the local currency, if it is not poorly managed and a lot of it is in short-term debt, then it becomes a problem again. So it's one of those. I don't know. Do we have any questions from Priya? Do we have any questions? Sam,
None
your
at
camera
the
is still
moment.
off. Okay. So what I also forgot to mention as I was doing an overview of the agenda is that Ms. Tembi will be also assisting me in moderating some part of the sessions. So we're gonna move over to the next session. Tembi, are you ready for your next session?
Yes, I am. Thank you, Adilali.
Okay, cool.
Okay, so
thanks. I think we can drop, right?
Yes, let me see if ever, are there not any questions from our participants, because we have you here for them.
I think there's one on BRICS.
And I could also do the AAA one very quickly.
Great.
So in terms of AAA, then at the moment we wouldn't see any change to that. All our AAA ratings have a stable outlook. None of the AA+ ratings have a positive outlook. There is pressure because a lot of these AAAs are in Europe. There's clearly pressure on public finances. The debt shock from COVID, there has not been a recovery in terms of the fiscal position. Still partly a legacy from that and the generosity of the government around COVID. Also political constraints on fiscal consolidations. You can see that a lot in Europe. Pressure from higher defence spending, pressure from ageing populations. Will some of these countries that have lost AAA go back to AAA? We've never had a sovereign that's lost AAA getting AAA back again.
Ravi, maybe we can just ask if there are additional questions. Directed to
Yeah,
you,
maybe
Paul.
I'll just add. I mean, yes, indeed. There, just to add to, I mean, Paul has kind of said similar stuff that I was going to say. I mean, indeed, on the AAAs, there is pressure, and with the same sort of issues that we're discussing, fiscal metrics, and if you're unable to control your fiscal debt stock, and you have an aging society which doesn't which builds up sort of pension liabilities but not develop strong GDP growth and productivity, then your metrics get worse and your AAA is under pressure. And we have seen, well, we moved on the US a long time ago, but basically, we've seen we still have quite a few AAAs, but indeed the universe has become a bit smaller. And maybe just to add there's another question is the BRICS bloc still planning to have its own credit rating agency, and how will it alter the funding landscape? I mean, there's a lot of talk around other rating agencies, and some have been formed. For example, the Chinese set up Dadong rating agency, and then now there's the Pan-African rating agency, which is being set up under the aegis of the African Union. I mean, ultimately, what we're looking at is an analysis of the country's ability and willingness to repay its commercial debt obligations. So if you and their job, if they were to come in with these other rating agencies, is basically to do the same thing. So the question is, who's doing it best and who's doing it well? Because if you have a new rating agency come in and you give very high ratings, and then somebody at a very high rating defaults, well, then clearly, those ratings were too high. So it's really trying to get an assessment of the accuracy of risk and the likelihood of default. So, and if consistently a rating agency gives higher ratings, well, then the market will look at it and they'll start to see that there's a rating differential, and they'll factor that into their bond pricing and their issuance. So I think there's no getting away from, strong sort of strong growth and fiscal consolidation that then delivers a stronger economy. Yeah, maybe I'll just leave it there.
Just a follow-up comment on that, Lilali, to Ravi.
Yes.
You mentioned the issue of comparability. If you have done a rating on Botswana, you probably want to compare it to similar countries across the globe. How does that finally impact the rating assignment you do?
Well, I think the criteria is designed for global comparability. So basically, to sort of avoid, I mean, there's specific regional issues, yes, but ultimately we're looking at a country's ability to repay its commercial debt obligations. So it's looking at that, and there's certain triggers that we've seen where, if thresholds go higher, then your rating is your risk of default is going to go down, is going to go up. So, we measure that, and we look and we look across regions as well. When we analyze, we're looking at data across regions. When, for example, we're looking at Botswana, we're looking at other commodity dependent economies and at a similar rating level, and we try to factor it in that way. So, yeah, global comparability, basically.
Okay.
Thank you.
I think in the absence of additional questions, we can let you go. Thank you so much for coming through and be part of these conversations. We really appreciate taking time in between your trips as well. Paul, as well, you can even yourself, if you don't want to be part, you are welcome to hang up if you want to do so. But we're going to move over to the next sessions now.
Thanks very much. Very nice to speak to you.
Let me just give you, Paul, maybe if you intend to also drop off your closing sessions also.
Sorry, I've got something else in 15 minutes. So,
okay.
But it's been, very very interesting listening to the discussion. Thank you.
Okay, thank you so much.
Thanks very much. Really interesting.
All right. We will have more of this in future, definitely.
Yeah, thanks.
Thanks.
My colleague will remain for a bit, Julia,
right.
if there's any further questions.
All right, thank you.
Great. Thanks a lot. Bye.
Thank you. Tembi?
Thank you, Alilali. I'm joined on this panel by Katlego and Lwandi and Sam. I think in the interest of time, I'm just going to consolidate and just ask them two questions regarding ratings and investors, and they can just each in turn take their contribution, and we'll hand over to you. Katlego, Lwandi, and Sam. To what extent have you seen investors integrating credit rating decisions, credit ratings outcomes into their investment decisions? And do they have a way in which they think about domestic versus hard currency debt, or they view those debts the same? And also, what can countries do to improve and communicate and engage with investors on the back of these ratings outcomes?
If I could go first.
Go ahead, Sam.
Please.
Thank you for that question. The pool of investors that we have seen, mostly within the domestic markets, have been institutional investors, pension funds, insurance funds, and institutions that basically have some component of savings that they need to find opportunities to invest. And obviously, these institutions are professional investors, and therefore they are seeking more insights into the risk that is being presented to them for investment purposes. So to the extent that they are interested in ensuring growth of their funds and also overall performance based in the economy, I think many of them actually do rely on credit ratings as an important component in the decision-making process. And therefore, through structures like the Capital Markets Authority, that is now being brought in as a condition that is required if one is going to market to raise money that is going to be used by these institutional investors. In terms of external funding, obviously, credit rating is the first measure that one looks at when they're trying to understand what kind of risk that is being presented to them. So again, at that level, multilateral institutions or investor pools, wherever they are, would consider these ratings as an important metric to just guide them on the type of decisions that they want to make. What we find that is not particularly perhaps driven by these ratings is the pricing of this money. Do the ratings actually drive the pricing? In some cases, it may not be the case. In some cases, it may be the case. But one would want to see that the price comparatives run across various other factors, so that you find that although one may be having a good ratings, but if you look at comparable prices in different markets, then the interest rate that is being charged is quite different. So although ratings do impact capital allocation in this market, but the issue of pricing still remains a challenge to most borrowers. And indeed, that has been the case when you look at ratings for African sovereigns, Most of their ratings are considered below investment grade, and the pricing that is associated with that is actually a concern. In the situation that I can refer to here in Kenya is where we've seen, for example, the government going into the domestic market and borrowing at very high interest rates, something like about 16% on one-year bonds, something like 12% on 90-day treasury bills. So again, with that in the market and government playing at that level, you would find that even if you have ratings, the pricing structure will tend to reflect what rate the government is borrowing at in the market. So you find again, the impact of ratings on pricing is not absolute per se. It tends to be relative to what other players are doing in the market. But we would like a situation where basically that ratings, investors should make decisions, particularly pricing decisions based on the ratings that potential borrowers have been assigned. So that's what I can say up to this particular point. Thank you.
Thank you, Sam. We'll hand over to Randy. Over to you. You are on mute, Randy. I can see that you are not on mute, but there is a problem with your speaker. Maybe let us go to...
Sorry, Luandi, can you click at the bottom right corner on the globe icon and then switch to English, the English channel? It'll say interpretation at the bottom right.
So it's the round button. It's called More, and then when you click on it, you'll see a globe will appear, interpretation. I still can't hear you. I think while we are sorting Randy out, let's maybe go to Katlego.
Yeah, I think thanks for that. The points that Sam made are quite apt. Investors definitely use credit rating agencies. They use them to also establish their own internal rating structures to inform investment decisions. So they just don't purely rely on what the rating agency says. They use it to build upon their own internal rating mechanisms that they utilize, especially in the public markets, to justify participating in specific assets. What the importance of rating agencies for me is from an informational perspective, and we know from the continent in general, we've always struggled with getting sort of timely, credible data available to inform, for information purposes, to inform decision making from funders, be it multilateral development banks, be it DFIs, or capital markets investors themselves. So I think initially rating agencies did plug a lot of that gap to ensure that they're able to go into jurisdictions, collate the information, and produce a report that everyone knows they can rely upon for information purposes, which is very important for efficient capital markets to take place and to happen. Now, it's kind of different with slightly with South Africa. Dr. Julie's earlier on, you were referring to our credibility of implementation relative to what we say we can do. But I think the one thing that South Africa initially did well was to engage with local and international markets quite regularly, which they still continue to do today. Maybe the credibility aspect of it, we'll touch on it later, but the frequency of communication is very important, particularly when the economy is going through headwinds. And we find that some economies, not necessarily African economies, but some even emerging market economies, when they face headwinds in the economies, they retreat. And that raises a little bit of suspicion from the investor community, which actually, when you're going through headwinds, is when you want to get in front of the guys so that they know that you're credible, they know that you speak up when even when things aren't going right in the economy, and they trust the information that you produce in the market that they can use to analyze whether or not to invest in you. For the public markets, rating agencies is very important, right? For the private markets, which are starting to develop and take place on the continent, particularly when looking at the large amounts of infrastructure investment that has to take place, right? A lot of that money will come from the private markets and has to come from private markets. Ratings might not be as important as in the public markets, so it's important sometimes to make that distinction, because for public markets, investors are looking to fulfill specific mandates that they have with the underlying pension funds, for example. So the underlying mandate might be you need to invest in a rated and listed security on a credible stock exchange. So at that point in time, that's all you look at. But if you put together a mandate that doesn't necessarily have to meet those requirements, and oftentimes you suspect that you might have better yield in the private markets relative to the public markets. If you have a mandate that allows you to get unrated, unlisted securities as an investor, you're quite comfortable to do that. So I think those are the points I want to raise at this point in time. Lwandi, I don't know if you can come in now. Maybe we can hear you now.
Sorry, Lwandi, we can't hear you. If you hover at the bottom left by where it says audio, can you click on the up arrow and try select a different microphone option?
I think while we wait for Lwandi Timbi, I cannot even see where I'm supposed to raise my hand. I mean, just going back to the point where Sam mentioned that, for instance, Kenya with 16% on their short-term debt. When I want to hear, maybe my question would be from the investor's perspective. There is high risk of default with a short-term debt of about 16%. Maybe what is it that investors think when they invest in such a short-term debt with such a higher rate? What are they thinking on that?
I think because it is in domestic currency and is basically government debt, then it does two things. For investors, it is providing them with an opportunity to invest in government securities at a much higher rate. And basically for government is trying to get more money from the market, and therefore the institution like banks then tend to depress their lending to private sector and channel their money to government. And so what then happens is that the general trend is that interest rates then go up even on private lending. And so because there is a belief that government will not default on domestic debt, so there's a bit of comfort that is achieved from an investor's point of view. But this would be quite different if this was on an external debt, because then servicing debt at that particular price would almost be an impossible task for government, and investors will therefore fear that there's a high potential of default on such instruments.
I think some of it could also be related to the level of the extent of the local investor pool. If the local investor pool is not that extensive, then you find that those dynamics play out quite acutely, where government is paying very high prices for local currency denominated debt. But if your investor pool is vast, there's a lot of funds locally that can invest in instruments and securities. In South Africa, we have a different problem. So we have a problem where our sovereign sort of issuance base is quite large, it's quite extensive. So, and also we get foreign participation, so foreign investors who buy rand-denominated bonds. which is also quite an interesting dynamic because those are the bonds that present the most liquidity by far in our local environment. And so we find that we're trying to grow the corporate local currency market for it to become more extensive. The banks are also quite big players in local issuances. SOEs historically were quite big players, but over the years they've dwindled a bit. But we're also trying to get them to come back to market to fund their activities and their capital expenditure requirements. And also, the mandate that the South African government has imposed that, so 55% of your funds have to be deployed locally, whether in the equity market or the fixed income market. And then you have a foreign offshore allocation, I beg your pardon, that's 45%. So that's those funds from local investors can be deployed offshore, but only up to 45% of the assets under management. So because we've got such a large and vast capital markets environment, we don't find that in general, we don't find that borrowing costs in local currency will be extensively high. They become high because of certain macroeconomic factors or where the yield curve is locally, but it's because of those factors and not necessarily because of the number of participants in the local issuance environment.
Thank you, Katlego. Lwandi, are you able to get on?
Hi, Tembi. Is it any better?
Yes, it is. Thank you. Now we can't see you, but we can hear you. But go ahead.
Don't stress. I'll turn it on the camera. Thanks, guys. Apologies again. Adilali, Tembi, great to be in contact, and also with the panelists as well. I mean, from my perspective, I think a lot of the points that I wanted to make a bit earlier, Katlego, for the most part, has flagged. I think I might be repeating and going back a little bit in this discussion, but just to highlight that, I think the most important element around everything we're discussing here is with regards to communication, right? The better the communication, the higher the level of transparency, the better the scenario for the underlying issue at its core, right? From our perspective, going back to what Katlego mentioned, the more regular the engagement, the better that you put yourself in a position to have investors support you even when you come under difficult times or times of strain. That's something that I think yourselves and your experience back at the National Treasury, you have extensive experience with the fact that the capital markets, for the most part, from your perspective, were never closed. And what was that led by? That was led by the fact that you had the open line of communications, and that when there was difficulty, that was something that you were able to communicate to the investor base. Well, it speaks to just a point that, like I said, was touched on earlier, was the importance of the credit rating agencies. I think with regards to underlying individual investors, that isn't a rule that they absolutely have a strict requirement for them to invest into these into your credit. What is always helpful, and I think it's important, is that a few of them do have some minimum thresholds that any particular issuer needs to adhere to prior to them being able to invest in or invest in larger sizes, and that's something that comes across. But underlying that, the individual asset managers and investment houses have their own models that they utilize and that they put at their core of their investment decision, which is going to drive a lot of factors, including the size they come in for, the tenor that they're willing to look at, as well as the price, and even something that Sam mentioned with regards to the currency of the underlying instrument as well. So I mean, I think those are the key elements that I wanted just to touch on from my perspective. I am conscious of time, so let me take this opportunity just to pause right there.
Thank you very much, Lwandi, Katlego, and Sam. I'll hand over to you, Alilali, to just take us through the last item in the interest of time.
Yes, I think I will just have one question. Thank you so much, Tembi. Thank you, Katlego. Thank you, Lwandi. I think maybe just one item. One question would be on how African countries, what are the prospects of us having an African indices? I mean, looking at what happened with China, where they got included in the MSCI, I think that was in 2017-18. And what are the prospects of us having that? And also, as African countries, how do we build into being included into this main rating, these indices? Lwandi, Katlego, Sam. And I think, Zweli, you have been quiet. I'm not sure if you're still on the panel. You can also come in as well before we close. We intend to close at 10:04. Thank you.
Noted.
I'm happy to
I'm
go first.
reminded that 1 minute each. Sorry.
Yeah. Okay, very quickly. I mean, at its core, Alilali, I think your question is a valid one. My counterpoint to that becomes, will the inclusion of an indice that is run or located out of the continent be beneficial and important in swaying the decision makers of the current providers of capital? My initial instinct is telling me that given how much we rely on the developed market investor base, there is going to be limited scope for that to have a meaningful impact in the context of our underlying issuances and debt raises, only given the fact that the primary decision makers of these institutions do sit obviously in the developed markets. And my question is, will the work that goes into that be something that catalyzes investment on the continent? If that's something that is, a particular, unmarked space that potentially have the chance to mine, then it's going to be something that has a little bit more benefit for us to look at exploring. I would hate for us to, deploy resources in that space, only to find that it doesn't have an impactful meaning or an underlying, subsequent trades, which, in the context of China, that is, quite not the case. They have significant debts and pools of liquidity that they'd be relying on, and still would be able to leverage in that context. So my instinct, having thought about it only now, is that there's limited benefit. But I'll hand over to my fellow panelists to apply.
Yeah.
Yeah, I'll also be very quick. I think I share Lwandi's sentiments quite acutely, because I think maybe not China per se, but when you look at economies like South Korea and Japan at the early inception of their development and capital deepening, the DFIs in those jurisdictions had a lot to do with it, right? Because, if you look at just normal cycles of how a financial market develops, it's always the banks, and then the capital markets follow the banks. So I think there's a bigger role for DFIs. We need to relook at, or not relook, but we need to ask questions around our DFI model on the continent. And they should actually be the drivers of development and infrastructure investment and growth from a funding perspective. And then the commercial banks, who are here quite significantly as well, and then the capital markets will follow before we put ourselves in any indices, because as Lwandi pointed out, we're just going to expose ourselves to more foreign funding, which might not be optimal at times from a pricing and perspective, right? So that'll be my contribution. Let's look at the DFI model. There's already precedents around the world as to how these economies like South Korea developed, and I think we can mimic aspects of that.
Priya, do we have questions on the chat?
I don't see any hand raised, Alilali.
Okay. Sam, maybe do you want to just come in on that, and then we close? Just 30 seconds, not a minute on this one even, so that we can close.
Okay. What I can say in closing is that if you're developing an index that can be interpreted by the investment community, then we've got to base it on market fundamentals, particularly in terms of markets that have embraced credit ratings. It would be very useful to have such an index, and I think any efforts that we can do would help investors understand price movements or risk movements across countries on the African continent. So it is something that should be supported in the mechanism put in place to see how we develop it. Thank you.
All right. I think that's all in closing. I'm going to hand over to Dr. K for her closing remarks, and then we close. Thank you very much.
Thank you very much. And I think I've got like 2 seconds. Just to say thank you very much to everyone for your participation and also for staying the longer mile. I am deeply regretful that the others have actually dropped off, because I think some of the insights and wisdoms that we have discussed and had quick inserts on now will actually lead our actions going forward. I am not an expert in this area, and even for me, I can see that we are talking about amplifying and enhancing what currently exists, and that we should look at those spaces which enable us then to use indices to communicate very well as to certain aspects or factors that are not currently being considered, but that would be more favorable to our local and developing context. So with that, I thank you most profusely, and certainly I know that Ali Lali will also be in contact probably with further information, further conversations, and we won't stop right here, right now.
Yes. Yeah.
Thank you.
Thank you so much. Thank you so much. We really appreciate your time and efforts, and all the participants, the speakers. We really appreciate you taking your time to be part of this conversation. Have a lovely day further. Thank you. Bye.
Thank you, and bye-bye.
Take care all.
Thank you, Adilali. Bye-bye.
Bye.
Bye-bye.
Thank you.